Hi, students. Here's the student spreadsheet that I put into Blackboard. I'm sorry I had the wrong one, but I put the right one on now. I'm going to work with this one because the one from last night, the instructor spreadsheet that I had up, had a lot in there that we really didn't need to discuss. I just want to show you how all of this works together. It's very simple. I mean, it's kind of complicated, but it follows on what we had with ornament horticulture. Remember this one, Exhibit 1, shows the forecast. This is set up in such a way that I'll change this number here. If I put 0.85 in here instead of 1, as you'll notice these numbers change and the forecast is a little bit less ambitious. It goes to sales to 77 million as opposed to the 90 million rupees. Anyway, so this table is used to construct the forecast, as we also need information on the balance sheet. We get to the historical balance sheet in the next table, Exhibit 2, again from the textbook, and also on the spreadsheet I put in there, shows what 1999, 2000 actual were, and as a result of based on a percentage of sales, we can see that sales level for the year is going to be, I think I didn't go back to that. We shouldn't have that 77 million. Bear with me a second. I made a change that I should have reversed. Need to go to Exhibit 1. Wonder why that didn't change. Okay, we're back to the 90 million in sales. And then, here we are. I'm sorry, I'm looking at the balance sheet. No, I'm not. So the balance sheet is going to show that from 2000 to 2001, total assets are going to grow from 13 million to 15.6 million rupee. Working capital, the short-term assets, current assets, will rise by about 2 million. And there'll be an increase here in accounts receivable, significant all across. This is all associated with an increase in sales. As a result, the borrowing requirements are going to go to 3.4 million by year end, which is going to breach the bank's covenant requirement that it be zero as a result of the cleanup. And so this is unacceptable to the bank. While they'd like to have the additional 15 million rupee in sales, the bank isn't willing to fund it, or they can't do it under the rules established by the bank in their loan agreement. Let's look at how we get to some of these numbers. This is the pro forma forecasted income statement. This is done on a monthly basis. We saw the annual 2000 and 2001, and this is showing what's going to happen in 2001 on a monthly basis, and the income statement is going to show what monthly sales are. This again is taken from that Exhibit 1. It's just shown horizontally instead of vertically. As we saw in class, they actually lose money in the early months and make all their money at the high season, June and July, when their sales are expected to reach 17 million, and then they go back to their losing ways because, again, it's a highly seasonal business. They still have to pay some expenses, but they're not selling very much because all of their sales occurred here. But at the end of the year, they end up making a profit. What happens to their balance sheet during that time? Well, their balance sheet follows proportionately. Their cash, this is managed and maintained at the 750,000 level. It's just the management's decision to keep that. As we mentioned, it's a safety stock, as they might call it, because of possibility of a shutdown in the plant, a strike, or whatever could happen in their economy, or even floods. These are countries that have monsoons and things like that, which could hurt transportation, could cause them. They still have to pay their bills, so they keep cash on hand. Their accounts receivable follow this pattern that is not based on just a ratio, but it's based on what is referred to as an accounts receivable aging. The aging, as we discussed, meant that 60% of the previous month's, 40% of the previous month's sale, and 60% of sales from 2 months earlier will be on the balance sheet as accounts receivable for each month. The inventories are based on 2 months worth of, on 55% of sales that are going to occur within 2 months, and that's this number here. However, this number inventory is based on cost of goods sold. It's not, they don't keep inventory to include they don't show the profit in the inventory, yet the profit is in the sales. So the inventory level is going to be based, the value of the inventory is going to be based on the purchases. And let's look at this here very briefly, how they calculate their inventory. I'm going to go to Exhibit 11 and show that they're going to be purchasing the value of their purchases will be 55% of the sales 2 months later. That's going to be in inventory. Those goods in inventory are also going to have to incur some costs in going from raw material to finished goods. So 34% of that value will be added in terms of wages. So going to Exhibit 10, we can see this more clearly, that again, this is the monthly change in inventories as we saw last night. This would be the, let's look at the purchases, for example. That's based on, again, 2 months forward sales, and 55% of that. The labor cost is the 34% of the of this number here. So that's the value added to it, and this is what is shipped is going to be this complicated thing up here is going to be the sales times the labor input times the purchases. So this is not going to be the sales level 1,000,009. It's going to be the cost of goods sold. That's what shipping is, and that's why it says this here. It's equal to, well, that's this one here, 55% of sales. So that's how they're going to get their determine what has happened to inventory. And in the end of the period, it's going to be beginning of the period plus whatever they purchased, which again is 55% of the value of 2-month forward sales. Labor cost is going to add to the value of inventory on their books. And again, that uses working capital because that money was spent on the labor, so it's captured in inventory and held in inventory. It had to be financed. And so this is showing what was the reduction in inventory based on shipment, again, all done in cost of goods sold, and at the end of the period, it is that. And that is rolled over. This number goes to here in the following month and so on. And you see the inventory levels peak in June, actually peak in May in anticipation of June sales. These are going to be sold in, actually, these are the orders, but they peak in May because of the seasonality. Sales hit in June, top off in June. Collections tend to pick up in the accounts receivable, end up maxing out in July, and we'll see more of this. See, this gets highest in July. So you see, this is the rolling, and this picture tells the story a little bit better. Where did the picture go? Here's the picture. So sales peak in June, accounts receivable peak in July because of the collection, inventory peak in May because they have to do it to sell. This is all the seasonality, and the accounts payable peak with their orders. So this is their flow. This is their cash cycle shown in pictures. I would study that a little bit when you get a chance. Only have about 6 more minutes of this to go. So in constructing this schedule of cash receipts and disbursement, it's going to tell us what happens to this number here. So all of these provide us with where the cash comes in and where it goes. The cash comes in from collecting on accounts receivable, and the cash comes in also from, this is the internal generation of cash, and this is external, by borrowing from the bank. They do repay the loans because they don't need it anymore. They've sold goods and they have to pay it down, and this is the incremental repayment of the loans. But the loan balance is based on the difference between what was borrowed, of course, and what was repaid. These are their disbursements. I need to expand this a little bit. And the disbursements will be whatever they paid to their suppliers, whatever they spent money on in terms of maintaining their equipment here, that $350,000. Again, we'll see that here as in Exhibit 11, that's required in order to stay in business, or at least keep the machinery running. They have to pay this interest on their debt, and that's given. It's a function of how much money they've borrowed. Their excise tax is paid. That's a function of their sales. Their operating expenses is 6% of their total sales. Wages are cash, and they pay this dividend to the owners every quarter. So these are all the cash that goes out here, and these are the sources of cash that come in. And these assumptions are, they drive the whole thing, their purchase, their sales, and so on. And the T account, again, that you've seen here are very, very helpful in understanding how they flow and how they get to these, and this is useful too. Anyway, going back to this, the net receipts occurred January. They actually spent more money than they brought in. So just a small difference here, but these numbers should be zero because the debt makes up the difference. If they weren't able to borrow, these numbers would all be negative. These numbers would all be negative, except in this period where they make some big collection. And even at this, I mean, I guess we could put zeros in here and see what would happen if they didn't borrow at all. Stay with me. They didn't borrow at all. This is what would be happening to their receipt. They would have have no cash at all. They'd be spending more cash. They would have no cash available to pay their bills. They would be getting cash in July, plenty of it, but people who worked from January to June have to spend money on groceries. They can't starve themselves until July and then start getting their paychecks. Just can't. Businesses don't work like that. And even then, at the end of the year, they'll be back to in the red. Let me go. Back to this. Finally, here are their cash balances. This is cash they choose to have on hand, which is the difference between, the cash that they had the period before and the cash they had. So they just maintain this. They're in effect borrowing to keep that cash on hand. That's borrowed money, but it is cash at that. It's not tied up in accounts receivable or inventory, which is one of their problems. Got about a minute left. So anyway, other thing to look at here is, again, this table is very interesting. Visualizes it graphically. Looking at this, you can see how this number is influenced. Any number you change here, if you want to make an assumption that, for example, that they can collect, we did this in class. Let's say they change their purchasing to purchase only, well, let's say they lowered their wages from 34% to 20%, which they can't because of union problems. Then, then they would actually be ahead because they would be making a big enough